Matt Horsley right here. Matty, how are you doing?
Doing great, Joe. How are you?
Hey, we're talking about do-it-yourself retirement. And I couldn't think of a better person to talk about do-it-yourself stuff because I think you've blown up your entire house once or twice.
Well, we've had to have a couple of projects redone.
Yes.
But everything's working properly now.
See, well, that's all that matters. Mistakes, because you are a man of mistakes.
I think we all are creatures of mistakes.
We are.
Yeah.
When it comes to retirement, let's kind of go through high level, just few things that if I'm looking at doing this on my own, okay, what are some high level things of someone in the profession for 25 years helping people retire? I mean, what are some of the mistakes that people are making?
Yeah, I think in the years that I've been doing this, I think the biggest mistake that people make is they become too emotionally involved with their investments. And a Nobel Prize winning economist that we all know of, Ken French, said, money is like a bar of soap. The more you handle it, the smaller it gets. And
was that Warren Buffett or Ken French?
Are you challenging me, Joe?
I don't know.
We'll look it up later.
Got it.
At any rate, I guess the point is that the more that people are emotionally swayed by what's happening in the market, there's really two emotions in investing that drive people's investment decisions, and those are fear and greed.
Sure.
And we see that all the time. And really what happens is that we all want to say, well, when the market is low is when I want to buy, and when it's high is when I want to sell. We're all taught from a very young age is to buy low and sell high. But what do we know people do in reality? And the numbers absolutely back this up, is that people buy high and they sell low. Right? It's like going to the department store and buying something when it's like the highest price possible, and then you want to return it once it's on sale and you get the sale price when you return it, right?
Yeah, but I mean, you can see why people do that.
Of course.
Well, let's say I'm 60 years old, right? I'm trying to do my retirement plan, and then this is the most money I've ever had in my entire life. You know, in your 20s and 30s, people aren't doing it, don't care, because who cares if you lose 20% of 10 grand?
Sure.
But if you lose 20% on $1 million, that's a lot of money.
Right,
so that emotion kills you.
Right, and that's the key, is as you approach retirement, like you guys were talking about earlier in the show, is you have to have a solid game plan in place. Because what I see, my experience in the business, is as you get close to retirement, let's say you're 3-4 years from retirement, or you're actually in your first couple of years in retirement, now the money that you've saved, you almost feel like, well, I can't afford to see the losses that I did when I was younger. But if you think about it, let's say you retire at age 65, your money might need to last you for another 30 years. You're going to see several corrections, bear markets, all throughout the course of the way. But if you're disciplined about your thinking and the way you're investing, you're going to be just fine as long as you stick to your strategy and your game plan moving forward.
Right, and I think that's a really good point, because let's say if you're 30 and you're retiring at 60, that's a 30-year time frame. A 30-year-old's not necessarily freaking out when the market goes down. So when you're 60, you still got that 30-year time frame, but our emotions, because the numbers are so much bigger.
And people forget about that, because when they're working, you're so like geared towards, well, I'm working, making money, saving money, putting the kids through school and all that stuff, that you forget about your investments, which is probably the best thing for most people to do. And when you look at the reality, what the numbers actually dictate is that the stock market, if you look at the overall Russell 3000 over the course of the past 20 years, has averaged about a 9.5% return. The average investor doing it on their own is average almost less, about half of that, 5.5% per year. So what does that say is that people are doing the wrong things, they're making mistakes, and like you said earlier, once you blow these things up and make some of those mistakes, you can't recover.
Sure. What about diversification? What do you see there?
So, I mean, key is we've heard the old adage, don't put all of your eggs in one basket, right? And when people are looking to invest their money, they hear, and I think the financial media sometimes does a really, really poor job of educating people about this type of stuff, because people look and they see, well, the Dow Jones and the S&P 500, they think if I just invest my money in the S&P 500 index and maybe a bond index and a little bit of money in international stocks, I'll be just fine. Well, we want people to fully diversify and have their funds invested across 16 different asset classes into 14,000 stocks across 50 different countries around the world. That's what gives you true diversification. So what does that do in the end? Well, if you have a game plan in place, and let's come back to that says, okay, well, if I've done all my proper planning, my proper tax planning, cash flow projections, I've accounted for inflation and different things that can happen along the way, I need to achieve my hurdle rate or my family index or rate of return, which might be 5.5% or 6% per year. So if that's the case, how do I build my portfolio to achieve those returns with the least amount of risk possible? What most people do when they come in to see us in our office is, well, they want the biggest returns and the best returns they can get. That's where fear creeps into it.
Sure.
If you're diversifying properly, controlling fees, rebalancing appropriately as you should be, because what happens is you have your initial allocation within your portfolio, right? We've all seen those pie charts. They want a certain percentage towards large cap, small cap, intermediate bonds, international, and real estate. But what happens over time is that those pieces of the pie are going to start to change, right, based upon market performance. So you have to rebalance properly. Those are all the things that if you're doing this on your own, you have to control, you have to pay attention to. I'm not saying, I talked about the bar of soap reference earlier. You want to handle your money, but handle it properly according to your game plan.
You know, and I think lastly with risk, I think there's a lot of misunderstanding or mistakes because every investment that you choose, right, there's risks associated with it. If I'm sitting in cash, I have a risk, right? It's inflation risk. If I am all in one stock, it's concentrated risk and so on. So I think when someone approaches retirement, they look at risk maybe differently than they should.
Well, it really has to be. And so when you diversify properly, as we just talked about, it's going to narrow the scope of the expected returns within your portfolio if you do that properly. But I guess one of the main points here in terms of risk is take risk where the market rewards you for taking risk. Most people don't get that. They're looking to try to maybe time the market, get in and get out based upon their hunch or based upon some of the stuff they read in some of these articles that tells them this is the 10 biggest ways to make yourself rich quick or whatever. But in terms of taking risks, there's certain areas of the market that reward you for taking risk. And we've talked about this in the past, is that small companies over time should outperform larger companies, and value stocks should outperform growth stocks. There's certain areas where if you have a slight tilt towards those areas of the market, you can achieve higher expected returns than if you just go out and buy an index with the S&P 500, for instance.
It's Matt Horsley, folks. Wonderful job. Wish I had you here all day, man.